The stock market continues to surge higher to new all-time highs, with the forward PE ratio of the S&P 500 now rising to 23, the most expensive valuation since the dot-com bubble crash, while Warren Buffett's favourite valuation indicator, the total stock market value to GDP ratio, makes the market bubble look even worse, as this indicator is absolutely off the charts now at a staggering 220%. We are now in never-seen-before territory, eclipsing the peak of the dot-com bubble, where the S&P 500 went on to fall by over 49%, as well as also being higher than the 2021 market bubble, where the S&P 500 fell by 24% in less than a year. But there are now a number of new alarming signals emerging across the financial landscape that suggest that this generational bull market rally could soon run out of steam, with a number of major financial institutions even warning that we are on the brink of a major market correction or something even worse. Now, these valuations start to look even crazier when we look at specifically the big tech or Mag 7 companies who have been a large driving force behind the overall market rally, with amazing returns for investors over recent years. However, the valuations of these companies have also been creeping up higher compared to the broader market, and the top 3 largest companies in the index are all sitting above a 37 PE ratio. We've also got other top 10 companies like Broadcom at a PE ratio of 88, and also Tesla at a PE ratio of 223, historically extremely expensive valuations, especially for companies that have such large market caps. Mag 7 companies now make up a whopping 31% of the entire S&P 500 market cap, a weighting that has been steadily growing in recent years, and the S&P 500 concentration index is at a record high. And the performance of the tech sector overall relative to the S&P 500 is now at levels higher than the peak of the tech bubble during the dot-com crash era. Now, although it is true that earnings growth in the Mag 7 group is vastly outpacing the broader market, which is largely driving the upwards growth we have seen in broad stock prices, this growth is now noticeably declining compared to the previous 2 years. And on top of this, it has come to light that some of this revenue growth is essentially fake, as there are very real concerns coming to light recently that these top AI tech companies are actually growing each other's revenue artificially in what is essentially a circular financing relationship. The top AI companies are investing hundreds of billions of dollars into AI infrastructure, including the top chips from the likes of Nvidia and AMD, but now Nvidia seems to be investing money back into these big tech AI companies. Now, they did recently announce a $100 billion investment into Microsoft-owned OpenAI for their data center build-out, raising questions about whether Nvidia are trying to prop up their customers and giving them funds to keep spending on its own products. Now, for a while now, Nvidia has been backing dozens of companies, including AI model makers and cloud computing providers, some of which then use that capital to buy Nvidia chips. Now, the web of connected investments goes very deep and would take too long to cover in detail in this video, but this Bloomberg graphic does summarize just how interconnected these top dozen or so AI companies actually are. These companies are essentially investing in each other or buying each other's products, which in turn gives everyone more cash to buy more products from other companies, and the cycle continues. Nvidia is the highest weighting of the S&P 500 and has become a barometer for the entire stock market. And although their revenue and profit have been extremely impressive on paper in the last few years, these recent circular financing patterns are ringing alarm bells for investors who are becoming more skeptical about how legitimate this growth is and whether these expensive stock prices are actually justified. By the way guys, the platform that I have been using recently for research and also some of the visuals that you are seeing in this video is called Forecaster, and they are kindly sponsoring today's video. The platform is a really great research platform that you can use if you are trading or investing in stocks and commodities, and has loads of different metrics, reports and tools that you can use to help analyse investments. I do in particular really like the AI tool, which is almost like a chat GPT for investors that allows you to get really quick and easy summaries of what's going on in the market or in the macroeconomic world or even in an individual stock. You can check out the platform by clicking the link in the description or the pinned comment, and if you do so you can get 10% off a paid subscription using that link. Now, we have also got a number of major red flags on the horizon for the broader US economy, which when combined with sky-high valuations and the other concerns already mentioned, it means that we are heading towards a potential perfect storm for a major stock market crash. Now, the labour market is showing extreme signs of weakness, which seem to only be getting worse by the month, with fewer new jobs being created, layoffs increasing, and also more jobs getting revised down. All of this is causing the unemployment rate to tick upwards, and the Federal Reserve has now stepped in and started cutting interest rates, stating the deteriorating labour market conditions as the primary reason for doing so. Now, this marks the beginning of what is likely to be a longer rate cut cycle in which we see numerous additional rate cuts in the future. Now, this is a big problem because inflation is still rampant and showing signs of rising further in the coming 6 months or so. This means that while the Fed desperately scrambles to save the jobs market, they look to be essentially sacrificing the inflation side of their dual mandate, letting it run hot. Now, this could be very bad for the economy because it means that we are heading towards a stagflationary recession where the economy is getting worse but prices are rising higher and higher. And although historically rates getting cut is good news for the stock market, it's not a good thing at all in this situation if the economy is in the gutter. And it seems like major institutional investors as well as global central banks can see the writing on the wall after this recent Fed rate cut pivot and continue to dump the US dollar and flock heavily into gold. Now, gold is now up a whopping 56% year to date as we continue to see global central banks favour gold over US treasuries for their foreign reserves, and institutional and retail investors alike continue to flock into gold ETFs. Now, gold is now at overbought territory according to forecasters' analytical metrics and has certainly risen extremely quickly in a short space of time. However, as forecasters' AI agent points out, with so much uncertainty around the US fiscal and monetary position, as well as in general in the wider geopolitical spectrum, gold could well continue to rise in the future. The US government only continues to issue new supply of treasury bonds, adding further imbalance to the demand and supply dynamic, which has been causing US treasuries to continue to decline. Investors can clearly see the massive debt problem that the US government has and don't want their money to be in investments that are not only likely to get devalued over time by new bond issuance, but also from a potentially heightened inflationary environment where the economy is in stagflation, eating away at the real returns on these treasuries. Now, Paul Tudor Jones, the billionaire hedge fund manager who became famous and successful from successfully predicting the 1987 Black Monday market crash, has recently just warned that a crash worse than the dot-com bubble is coming. He does say that the market reminds him of the setup leading to the burst of the dot-com bubble, saying, "If anything, now is so much more potentially explosive than in 1999. Now, Jones also highlighted that the circular deals happening in the AI space today makes him nervous. We've also seen Jamie Dimon, the CEO of JP Morgan, also just warn that there is a heightened risk of a significant correction in the US stock market within the next 6 months to 2 years, and he thinks that investors are downplaying this risk. He also added that AI will probably be wasted money, and some investors in the technology may end up worse off. And this hyper-concentration towards AI companies goes deeper into the startup and private market sector too, with 60% of VC funding now going into AI companies, which exceeds the 40% that went into internet companies in 1999. We have also seen a similar recent warning from Amazon's Jeff Bezos, who says that spending on AI resembles an industrial bubble akin to the biotech bubble of the 1990s, despite expecting AI to improve productivity. And Bezos does make a good point here, because although the market does seem frothy right now, AI does have real potential to improve productivity and help many companies become more efficient. This is especially the case for the big tech companies who can leverage AI to improve their business efficiency and continue to rapidly grow their revenue and profit like they have been doing in recent years. This could therefore lead to a situation where fundamentals catch up to stock prices, where we could ultimately see valuations get more reasonable without a major stock market crash. Now, another market in big trouble right now is the housing market, as there are now a number of very concerning indicators flashing red, with affordability at an all-time low, the demand and supply imbalance continuing to get worse, all while the economy looks set to weaken massively, as we discussed earlier, which could be the perfect storm for a major housing market crash. Now, I covered this topic in more detail in my previous video, which you can check out by clicking on screen right now. Aside from that, guys, remember, if you want to keep your finger on the pulse for everything related to the investing world, then do check out Forecaster, and once again, if you use the link in the description or the pinned comment, you can get a 10% discount off their paid plans. Aside from that, if you enjoyed this video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.